Starting with the 2020 A-level paper, question number 26. Suppose that in a hypothetical economy, real GDP equals 80 trillion, nominal GDP is 240 trillion, general price level equals 3, money supply in the economy is 30 trillion, velocity of circulation money is. Remember guys, I told you all, when they have given you percentages, you have to remember, okay, what do we have to use here? We have to use MV equals PT. When they have given you percentages, I told you have to add. Have they given you percentages here? That it has increased by this much, that decreased by this much? No. Now you can multiply. Now you can do it the normal way. Okay. See, real GDP is 80 trillion. Now, I'll make this PY. Okay. So, this Y is only your real GDP. Lama. How much is that? That is 80. Nominal GDP 240. That means this entire thing. PY is only nominal GDP. This is 240. Okay. General price level 3. They don't even have to give that. We can itself find. So, correct. No? 3 into 80 is 240. Makes sense. Money supply is 30. Okay. They're asking you how much is the velocity of circulation. Simple question. So, for you to get 240 here and to get 240 here, 30 should be multiplied by how much? How much is your velocity of circulation? 30 has to be multiplied by 8. Got it? So see, remember when they give you percentage rises, remember we did it in the previous papers. If they said money supply increased by 10%, nominal GDP increased by 5%, then what will happen to price level? If they have given you percentage rises, you add the percentages. If they have given you absolute figures, money supply 10 trillion, velocity this much, price level this much, then you do the normal MV equals PT, multiplicate. So answer number 1. Is that okay? MV is money supply into velocity of circulation. There is no name like that. Combination. Okay, 26. Then 27. Assume that one of the commercial banks in the banking system has excess reserves of 400 million. Okay. SRR is 20%. Meanwhile, a customer of this bank deposits 25 million in his current account and the bank lends, the question is incomplete. Can you give me the number here, guys? I have missed the number when typing. Bank lends how much? What is the question? Bank lends rupees, make this correction guys, bank lends rupees 120 million. The question is asking what lending can be granted? The new lending that can be granted, no? I have missed a few words. The new lending that can be granted by bank, that's what they're asking, right? The additional lending. Yes, no? What is the other part? The amount of new lending or the amount of new additional lending that they can grant. Okay. This is an interesting question, Lama. Okay. So, the additional lending, no? So, this one, make that correction. Additional lending. Okay. So, now this is a very interesting one. You have to figure out, okay? You have to figure out how much of excess reserves can be there. How much of additional lending can be granted by this bank? Okay, right. How much of additional rate? So, how much of excess reserves they have? The excess reserves they can give out as loans. We'll think, okay? Here we have excess reserves. So, excess reserves is what they can give out as loans. Okay, very interesting question. See, they say at the beginning, the bank has excess reserves of 400. Do you all agree? So, at the beginning, they could have given additional lending of 400. Then what happened? SRR is 20%. This is excess, huh? So, you don't have to take 20% of that. A customer of this bank deposits 25. So, when a customer deposits 25, how much should they keep as required reserve? They have to keep 20% of this. How much is that? They have to keep 5 million. Then how much of this gets added to excess reserves? From that 25, how much gets added to excess? Now they have 420. Do you all agree with me there? At the beginning, they had 400 million excess. Now a customer came and deposited 25. SRR is 20%. So from that 25, they have to keep 5 as required reserve. The remaining 20 is excess now. You all agree? Remaining 20 is with them. Okay, so now the bank has a total of 420 million of excess reserves. Then they are saying, and a bank has also lent 120. So when you give money from your excess reserve now. So they have also given a loan of 120. This is a loan. So how much of excess reserves do they have now? What is the amount of excess reserve the bank has now? They had 420. They have given 120 as a loan for a new customer. So now they only have excess reserves of how much? Of 300. So the question is asking how much of additional lending can be granted by the bank now? How much of new loans can they give? If another customer comes and asks, how much can they give? This 300, no? This is the amount that they can give. So which one is our answer then? Number. Is that clear? That's an interesting question. So when they ask you how much of additional lending a bank can give, it's the amount of excess reserves the bank has. So quickly to summarize, at the beginning they say bank had 400 million excess. So that means they can give that out as loans. So re-explaining guys, at the beginning they said the bank had 400 excess. That means that is the amount of additional lending that can be given. Customer came and deposited 25. From that 25, you can't give the entire thing as loans. No? 20% you have to keep SRR. So only the 20, remaining 20 you can give out as loans. From the 25, 5 SRR, remaining 20 you can give out as loans. So now the bank had 420 million that they could have given out as loans. Okay, excess reserves. Then what happened? Another customer came and took a loan of 120 and went. So now the bank has how much? So if you minus this 120 also, now the bank has only 300 million of excess reserves. So now how much of additional lending can they give? Now additional lending that they can give is only a 300 million. Because that is the amount of excess reserves that they have. Is that clear? Yep. It's an interesting question to think. Okay. Now, then going into 28. Okay. Again, very easy, guys. This one. What are the main objectives of Central Bank of Sri Lanka in implementing monetary policy at present? What is the main objective? Price stability and financial system stability, price stability and full employment, price stability and sustainable development. What do you think? The answer, guys, is what? The answer is number 1. Price stability and financial system stability. From these two also, which one is the most important one? From price stability and financial system stability, price stability is the most important. Recently also, the central bank governor issued a statement saying, by any chance, if these two, we had to choose. Now, they don't have to choose. It's not contradictory objectives. By any chance, at any point in the future, if we had to choose between price stability and financial system stability, they will choose price stability. They will prioritize price stability. They will not care about the financial system stability. But usually you don't have to choose between now. In a commercial bank, you have to choose between profitability and liquidity. No, if you increase profitability, liquidity goes down. Here, it's nothing like that. You can have price stability and financial system stability both together. But governor said, by any chance, if they had to choose, they will go with price stability. Financial system stability means, guys, the financial system is properly functioning. The banks are not collapsing. The financial markets, the treasury bill, treasury bond markets, all of that is properly functioning and going. Remember in my theory class, I explained how Ceylon Bank was going to collapse because of this issue with the finance, how Ceylon Bank was going to collapse, how customers kept on started withdrawing their money from Ceylon Bank, how the central bank intervened and protected Ceylon Bank. That is financial system stability. Yes, kind of like a bank run. If there is a bank run, to make sure that it doesn't happen, because if one bank collapses, all the other banks will eventually collapse because people will lose confidence. So to make sure that it doesn't happen and the financial system is stable, that is what we call financial system stability. In terms of any external law, any shocks that come, till the financial system properly functions. Okay, that's 28. Then 29. Suppose that the SRR is 10%. Central bank conducts an open market purchase of 300 million from commercial banks. What is the maximum possible change in money supply resulting from this purchase? Very easy, no? Think. SRR is 10%. If the SRR is 10%, how much is your deposit multiplier? Deposit multiplier 1 over SRR, that is a 10 times. So if the central bank goes and purchases, okay, first of all, guys, if the central bank conducts an open market purchase of 300 million, will money supply increase or decrease? Tell me that. Central bank is now purchasing treasury bills or bonds. Central bank is purchasing. That means they are giving the money to commercial banks. No, commercial banks are selling. Central bank is giving money to commercial banks and buying. So what happens? Money supply will increase because why? Commercial banks, banks reserves will increase. So banks reserves will increase by 300. So when commercial banks reserves increase by 300, they can give this out as loans. So then credit creation starts happening. They are asking you what is the maximum possible increase in money supply. So when credit creation starts happening, deposit multiplier is 10 times. So this can get multiplied by a 10. Then money supply can go up by how much? Money supply can go up by a 3,000 million. Yeah. So can you see this? This is what you call now. Remember, we study in theory. When the central bank purchases treasury bonds, money supply will increase. Look at the numbers. Central bank purchases 300 million worth of treasury bonds. Okay. Commercial banks get that money. Commercial banks can give that out as loans now. So then credit creation happens. It goes from one bank to another bank to another bank. So money supply at the end increases by 3,000 million. That's how it works. So increases by a 3,000 million. Opposite will happen if the commercial bank sells. Now, if in your paper, they can ask that. They can say if the commercial bank sells a treasury bill or government securities worth 100 million, what will happen to the money supply? So you need to figure that. Is that okay? 29. Okay. We'll go to 30. Okay, this is easy, guys. Monetary policy affects aggregate demand through changes in what? Direct and indirect taxes. Yes, they've asked for a change in money supply. So money supply will go up by 3,000. Currency held by public is not affected. Money supply CC plus DD. Central bank, when they purchase treasury bonds, reserves go up. Demand deposits will go up. Given out as loans, demand deposits go up. CC is not affected. So M1 equals CC plus DD. According to this, DD goes up by 3,000. Currency held by public is not affected. They are not saying that a customer is depositing or customer is withdrawing. So therefore, money supply also goes up by 3,000. Which one is this, guys? Monetary policy, how does it affect aggregate demand? Especially monetary policy is interest rates, right? What did I tell you? Interest rates affect what? We have been speaking about this for all the past papers. What happens when interest rates change? It affects consumption and investment, no? When interest rates decrease, consumption will increase, investment will rise. If interest rates rise, consumption will fall, investment will fall. Proper basic monetary policy, how it affects aggregate demand. Then 30, no, that's it. Yeah, so it's a single bank, commercial bank gives money to one of the banks and then credit creation happens. Remember, guys, when they say money supply, you always have to take the banking system. When you take money supply, you can't just look at a single bank. Money supply is the end. entire money supply of an economy. So, central bank is selling, purchasing a treasury bond from one of the banks. Fine, they are giving them 300 million. Because of that, they are asking what will happen to money supply. So when you talk about money supply, that means at the end of the credit creation, after that 300 million has been given out as loans and all, what can happen? So always remember, money supply, you need to work with the banking system, demand within the banking system, not this. Interest rates is what, yeah, if they ask directly what will happen to the bank's reserves or something, you can say increase by this thing. But here they're asking, you know, what is the maximum possible change? That means they're talking about the whole story. You need to figure those. Interest rates is what is affecting consumption. So interest rates affect both consumption and investment, guys. Now, for example, that is what we have been learning all this time. So when interest rates increase, what will happen to consumption? Will people buy things on installments? Will people take credit cards? No, consumption will come down. On the other side, what will happen to investments? Will firms borrow and invest? Will they expand, start new factories, buy machines? No. So when interest rates increase, consumption investment comes down. On the same side, the opposite. If interest rates come down, now people will buy stuff on installments, they will get credit cards, consumption increases. Firms will borrow, they will invest, investments increase. So interest rates affect consumption and investment. Consumption and investment are components of aggregate demand. That's how it works. That's how they control aggregate demand. Export demand is not, it's also not very connected. Mainly it's consumption is. Interest rate is changing the consumption, right? This doesn't affect interest rates. No, so what do you mean interest rate is changing the consumption doesn't affect interest rate? So interest rate is being changed. How can you say interest rate being changed doesn't affect interest rate? Monetary policy, what is monetary policy? Monetary policy is about interest rates and money supply. So when you change interest rates, it affects consumption investment. So export demand, guys, won't depend on your interest rates. No. Now, let's say Sri Lanka is exporting tea and garments. So our export demand is not going to be affected by what our interest rate is, right? The foreign companies are still going to demand for the same amount of tea and same amount of tea. The same amount of tea and same amount of garments. Whether our interest rate is 2% or 5%, they don't care. They are still buying 100 kilos of tea and 500 t-shirts. Yeah. Yes, all this time we have been talking about how interest rates affect consumption investment. Why are you all going with a different answer? Is that okay? Fine. 30 questions, anything? When interest rate is high, the production should decrease. So the exports can go. Okay, maybe yes, you can argue that way, but they are not talking about export production also, you know, they're talking about export demand, you know. But again, even if they say exports also, there is a more correct answer. You can't go with exports when they have told consumption and investment. And even if they have, let's say, split consumption investment, then the most correct would be investment. That is the most affected by interest rates. You have to go with the main answer. You can't argue that exports will these things, so that has to be the answer. Remember, I told you, always go with the most correct one. Consumption is the dependent variable. That doesn't change, right? No, so consumption doesn't change the interest rate. Interest rate will change the consumption. Consumption is dependent, yes. So the question is saying the monetary policy affects aggregate demand through changes in what? So according to monetary policy, interest rate change. So when interest rate changes, consumption and investment will get affected. Consumption investment is the dependent variable, yes. Okay. Fine, anything else on 30? Okay, so then that is it with 2020. See how did you all do so far? There were 1, 2, 3, 4, 5 questions. At least 3 or 4 now. Yes, please make sure after this you all go through the questions again, right? Otherwise, if you're not learning anything, then there is no point. After you do all this, again, properly go through every single MCQ, see where you went wrong, how can this come, then only you all will improve. Just doing 1,000 questions is not the matter.